Hi guys, welcome to my channel. Today I will be talking about various US Treasury securities and why sometimes the short-term Treasury securities like T-bill can give you higher interest rate than the longer ones. I know it seems counterintuitive, but please watch this video to understand the reason and make better investment choices. If you are new to my channel, my name is Parul. I'm an economist and I make videos on personal finance and I try to simplify complicated economics so that everybody can understand and make smart money decisions. Okay, first things first. What are treasury securities and what are the different types available? Treasury securities are debt instruments issued by the US Department of the Treasury, and they are to finance government spending activities. So, what are the main characteristics of Treasury securities? Number one, safety. Treasury securities are considered one of the safest investment available because they are backed by the US government. Number two, liquidity. Most treasury securities are highly liquid, meaning they can be easily bought and sold in the secondary market. And third is the tax treatment. So, interest earned on treasury securities is exempt from state and local taxes, though you still have to pay federal income tax on them. So, how do you buy treasury securities? You can purchase treasury securities directly from the US Treasury website through Treasury Direct or through banks and brokers in the secondary market. Here's an overview of the main types of treasury securities. So, the first is treasury bills or T bills. These are short term securities with maturities of 4, 8, 13, 26, or 52 weeks. They do not pay periodic interest. Instead, they are sold at a discount to their face value, and you receive the face value at maturity. The difference between the purchase price and the face value is the interest earned. T bills are typically used for short term funding needs. The current rates are approximately 5.2 to 5.4% and they vary by maturity. The second is T notes. These are medium term securities with maturities of 2, 3, 5, 7, or 10 years. They pay fixed interest rate every 6 months until maturity. T notes are often used by investors who want a predictable income stream over a moderate period. Current rates range from 4.1% to 4.3%. The third is the treasury bonds or T bonds. They are long term securities with maturities of 20 or 30 years. They pay a fixed interest rate every 6 months until maturity. Okay, T bonds are ideal for long term investors who are looking for steady interest income over many years. Current rates are around 4.3% to 4.5%. The fourth is the Treasury Inflation Protected Security or TIPS. These are available in 5, 10, or 30-year terms. TIPS pay a fixed interest rate, but their principal value adjusts with inflation as measured by the CPI index. Interest payments are made semi annually based on the adjusted principal. TIPS are designed to protect against inflation and it makes them attractive to investors who are concerned about rising prices that can erode their returns. As of now, yield is generally lower than nominal treasury, which is around 1.5 to 2% after the inflation adjustment. Next is Series I savings bond, and they can be up to 30 years and can be redeemed after 1 year with a penalty if they are redeemed within the first 5 years. Series I bonds earn interest through a combination of a fixed rate, which stays the same for the life of the bond, and an inflation rate, which adjusts every 6 months based on changes in the CPI. These bonds are low risk saving products for individual investors, so they offer inflation protection. Current rate is around 4.3%, which is 3.4% for inflation and adjustment and 0.9% fixed return. Okay, the next is floating rate notes. These are maturity of 2 years and they pay interest quarterly based on the discount rate of the 13-week T. Floating rate notes or FRN are used for investors who want to protect against rising interest rates. Current rates are around 5.1% and they fluctuate based on market conditions. So it's good to check the latest data whenever you decide to invest in any of these. Okay, now let's move to the second part of the video where I will explain why interest rates on some longer term securities like T bonds and Series I savings bonds and TIPS are slightly lower than the short term securities like Treasury bills. This I know is counterintuitive, but I will explain to you how this phenomena can be influenced by several factors. So, the first factor that affects is the expectation of future interest rates. In economics, there is something called inverted yield curve. When investors expect future interest rates to decline, they might be willing to accept lower yields on long term securities. This is often seen during periods of economic uncertainty or anticipated economic slowdown. As a result, the yield curve can become inverted, meaning short term rates are higher than long term ones. But usually, we would expect a normal yield curve where long term bonds would give you higher yields to compensate for the risk of holding a security over a long period, known as the maturity risk. However, in certain economic conditions, like as of now, this reverse relationship can happen. Second factor is inflation expectations. Longer term securities generally require an inflation risk premium because they expose investors to the risk that inflation will erode the purchasing power of their returns over time. If investors believe that inflation will be low or controlled in the long term, they might accept lower yields on the long term bonds. TIPS and Series I bonds are specifically designed to protect against inflation. So their base interest rates are often lower because they include an additional inflation adjustment mechanism. Investors accept the lower base because they expect to be compensated through inflation adjustments. The third factor could be the demand for safety and stability. In uncertain economic times, investors may prefer the relative safety of long term US Treasury security, which are considered one of the safest investment globally. High demand for these securities can drive prices up and yields down. Also, short term securities like T bills are more liquid, easier to sell, and less sensitive to interest rate changes. Investors might require a higher yield for committing their money for a long term, but in times of uncertainty, the demand for safe long term bonds can increase, which can push the yields down. The fourth factor that affects this is the Federal Reserve policy. Monetary policy can have a significant impact on short term interest rates, especially through its control of the federal funds rate. If the Fed keeps short term rates high to fight inflation, it can cause short term yields to rise while long term yields remain lower if the market expects rates to decrease in the future. Okay, let me elaborate a little on Series I bonds because these are designed for individual investors who are looking for safe investment with inflation protection. The interest is a combination of a fixed rate and an inflation rate. Since part of the return is tied to inflation, the fixed rate is typically lower. Also, there are some tax advantage. The interest earned on Series I bonds is tax deferred until they are redeemed, which can make them more attractive even at lower interest rates. So, in summary, the lower interest rates on long term securities reflect the market's expectation about future economic conditions, inflation, and interest rate trends, as well as the safety and stability these investments offer. If you found this video helpful, don't forget to hit the like button and subscribe for more tips on making and managing money. Thank you so much for watching, and I will see you in my next one. Bye.